Say is investors don't want to overreact. The bond market's not going to collapse tomorrow, so they shouldn't be pulling money out of treasuries and putting it all into a money market fund unless they're going to be happy with a return of 0.06%. At the same time, you probably don't want to be too heavily invested in long-term treasuries either. The bond market's very volatile, and trying to wait and get out at just the right time before it collapses is a sucker's bet.
Okay, now let's give you the middle ground here, man. Where should investors put their money if they want to keep it safe?
Well, this is exactly the kind of thing I'm talking about with my own father. I'm managing his retirement portfolio right now, and we're starting to put some money to work in the market. I haven't figured out exactly what we're going to buy yet, but I'll tell you what I'm thinking. The first place we're going to start is select dividend stocks, which will pay out even in the event of a decline in the bond or the equity markets.
Won't dividends, though, also be affected by rising interest rates?
Well, that's a possibility. If interest rates go super high, it's going to affect everything. That's why you have to be careful what industries you choose, like utilities, for example. They're heavily dependent on interest rates, both because of their businesses and also because they're income investments. So I'm going to suggest that my father buy the dividend stocks I think are safest, even if interest rates go higher.
Okay, such as what?
Well, I'd recommend extremely conservative stocks, mainly consumer staples plays. Defensive companies that have business models that you can understand, that sell products whether there's inflation or deflation. They're the steady eddies of the world.
Oh, I like those. Give us an example.
Well, Altria is a good example, okay, and it's one of the first stocks I recommended 3 years ago to my newsletter subscribers. It's formerly known as Philip Morris. They're the company that sells cigarettes and wine, products that typically do well even during recessions. Altria is up about 7.7% in total returns since I launched my newsletter in the summer of 2007. And over that same period, the S&P 500, the broad stock market, is down more than 25%.
Yeah, but you look at Altria's chart, it looks like that stock is down over the last 3 years.
Well, it looks that way, but that's because the stock chart doesn't show what it yields in dividends. It's about 7% every year. And that's exactly why you should be using dividend stocks to hedge against the down market.
Okay, any plays in the bond market you'd recommend?
Well, I'll tell you the first thing. I wouldn't be buying treasuries right now. I think the best way to guard against a jump in interest rates and the inflation that would come with it is with Treasury Inflation Protected Securities, or TIPS. You can buy them as individual bonds, you can buy exchange-traded funds or mutual funds that focus on them, and whatever way you do it, I consider them very safe long-term investments. They're going to protect you if there's inflation, and they're going to protect you if there's deflation. Either way, you're not going to take a big hit.
Okay, Nilus, tell your dad we said hi.
I'm going to. Thanks.
All right, man. The stock market, it can be risky even in the best of times, and we've heard how dividend stocks can pay out even during a downturn. But if interest rates surge, some stocks likely to be most affected, financials. Coming up next, Weiss Ratings will give us its picks and pans in that industry. And a bit later, we'll get a look at a commodity play that may be set to go through the roof. Stay with us.
Hi there, this is Mike Larson, editor of Weiss Research's Safe Money Report. You can't just focus on stocks anymore if you want to be a successful investor, and you can't just focus on the United States either. You need to know what's going on in Asia, which Tony covers. You need to know what's going on in hard assets like oil and gold, which Sean and Larry are on top of. You need to know what's happening in currencies, the specialty of Brian Rich. You also need to keep abreast of the best ways to build wealth in an era of near 0% interest rates. And that's what my colleague Nilus Mattive covers. And of course, you need the top-down, big-picture analysis that Safe Money delivers to you each and every month. Best of all, the Weiss Elite membership gives you access to all of that and more. The Weiss Elite gives you the tools and knowledge to profit from all of these market developments. Now, I may be biased, but I think it's a no-brainer. And I'm glad you're one of the smart investors who recognizes that fact. Thanks for your time.
The U.S. bond market is in danger. What does that mean for the other markets, and how can you protect yourself? Once again, Jamie Holmes.
Interest rates may not go up immediately, but oh boy, when they do, some financial institutions are going to find themselves in, guess what, the middle of another crisis. To prepare for that day, Weiss Ratings has compiled a list of banks that are well positioned to survive a jump in interest rates and those that, well, are not. All companies, not just banks, have assets and liabilities that reprice from time to time based on interest rates. the relationship between those assets and liabilities that's called the gap ratio. Now, the banks that will do well in a high interest rate environment are those with a high gap ratio. In other words, their assets will reprice faster than their liabilities over the next year. If a company has a negative gap ratio, its liabilities will reprice faster than its assets, meaning its profitability, well, it's going to suffer. So, which banks have the highest gap ratio and are positioned to survive a rise in interest rates? According to Weiss ratings, Stifel Financial will perform best among the banks with a gap ratio of 59%. BANGKOK, Texas Capital Bank Shares, Marshall and Isley, and a Bank of South Carolina are also all well positioned. Now, keep in mind, this is just one indicator of a bank's health. So before running out and buying these stocks, do some homework. Also remember that companies can adjust their asset liability strategies, so those numbers, well, they may be changing. On the other side of the spectrum are those banks with negative gap ratios. CCFNB has the most liabilities set to reprice over the next year relative to its assets. Smithtown Bancorp, Oriental Financial Group, Republic First, and ENB Financial also have gap ratios that are deeply negative. In dollar value, Oriental Financial is the worst offender, with more than $3.5 billion on the minus side of its ledger. Now again, gap ratios alone shouldn't convince you to sell your shares in these banks if you hold any of them in your portfolio. But if you are convinced a rise in interest rates is coming, it is one factor you should be looking at when you're deciding how to position yourself to survive. We're going to bring you more investment ideas from Uncommon Wisdom Daily and a dissenting voice on interest rates when Money and Markets returns.
America is in trouble. Federal and local governments owe over $123 trillion. New debt is escalating at the rate of $183 million per hour. That's $1.6 trillion per year. Bond prices are plunging, and that could drive interest rates sky high, triggering an even deeper recession. If you are worried, and you should be, download Mike Larson's blockbuster new report with urgent investment recommendations to help you protect your wealth and profit. Don't delay. Do it now.
We've heard that the U.S. bond market is headed for a collapse, but as the economies of Europe struggle to prevent the sovereign debt crisis from spreading, some say that the U.S. is looking like a safer investment than ever. Others say the U.S. is no longer a safe haven, and we have only to look at what's happening in Europe to see our own future. Weiss research analyst Larry Edelson is one of those people. He has some ideas about how investors can protect themselves. He joins us from Bangkok now. Larry, what are you seeing in Europe that leads you to believe we're going to face similar problems here in the U.S.?
Hi, Jamie. Yes, I do believe that Europe is a sneak preview of what we're going to see, unfortunately, happen in the U.S. But let me address your question head on. In a nutshell, what we're seeing in Europe is debt problems. And the euro is collapsing because at the root of the problems there are massive unpayable debts. There's also a problem with the currency there. The euro was put on kind of backwards when it was born in 1999, and it was a recipe for disaster right from the start, which I warned about more than a decade ago. And now we're seeing that combination of a fatally flawed currency and a massive mountain of debts tumble like a house of cards. But you know how it relates to the U.S.? It relates because the dollar is in not only a similar danger to the euro, it's actually in worse shape. Sad to say, because I'm an American citizen. But you know, the U.S. has more debt and more IOUs out there than Europe does by far. And our Federal Reserve is by far the most aggressive central bank in the world, printing trillions of paper money to try and get not only the U.S. economy, but the global economy out of this disaster. And they're printing more than the European Central Bank. So, you know, I believe the crash you're going to see in the dollar is going to pale in comparison to the crash you're seeing in the euro.
Larry, I was talking to Mike Larson earlier. He compared the U.S. bond market to the stern of the Titanic before the whole ship sank. Would that be accurate to say about the dollar as well?
Absolutely. You know, again, the dollar may be temporarily strong, but you know, even as the euro plunges, overall, you know, the dollar, as I mentioned before, it's down 30% since 2001. Its rally has been a meager 13% off its record lows. So, you know, that's a very weak rally in the dollar. I don't think it has any chance of surviving the sovereign debt crisis. And I believe in a couple of years' time, the dollar will actually lose its status as the world's reserve currency. It will have to.
Okay, Larry, so when the sovereign debt crisis hits here,